morning to all. My name is Vanessa Beekman. I'm a sales manager at Isabel, and I will be your host for today. Now, on behalf of the Isabel 6 and the Western Union Business Solutions teams, I'd like to welcome you to this webinar, which is entitled, How Will the US Presidential Elections Impact the US Dollar? It will be George Vessey, FX strategist at Western Union Business Solutions, that will take you through this interesting and hot topic these days. Now, first of all, on a practical note, the webinar itself will take about 40 minutes. And if you have questions, we ask you to send them via the Zoom Q&A button at the bottom of your screen. Send them over whenever you want throughout the presentation, but please be informed that we will take your questions at the end of the session. It could be that we select some of them depending on the time we have left. Now, by all means, we have the privilege having some foreign exchange experts around the table. So please shoot your questions and seek for advice from the experts. Before giving the floor to the Western Union Business Solutions country heads for Benelux and France, Marc-Élie Caspar, and their foreign exchange strategist, George Vessey, I would like to take the opportunity to welcome Western Union Business Solutions as a new partner of Isabel Group since September. Now, what this partnership means for you as a long-standing customer of Isabel 6 is that you will get access to real-time foreign exchange currency conversions when doing an international payment in a foreign currency via your trusted platform, Isabel 6. And as such, Isabel 6 provides you with a simpler, faster, and more efficient international payment service, this in collaboration with a trusted partner that has a European banking license. Thanks to Western Union Business Solutions, the business division of Western Union, your company will have access to a global payment network of over 200 countries, and that in more than 130 currencies. I will now give the floor to Marc-Élie Caspar, who is the country head of Western Union Business Solutions for Benelux and France.
Thank you very much, Vanessa. Thank you very much. Good morning. Welcome to all of you, and thank you for participating in this conference, which will give us the keys to understanding the challenges and importance of the US elections and its impact on the financial markets in a context of global crisis and pandemic. Western Union Business Solution is the B2B division, as Vanessa said, of the Western Union Group. We are the global leader in international payments and in FX risk management for businesses with digital platforms and trading rooms that support our clients. We operate under a European banking license as a bank, and we are present in 200 countries in 135 currencies. We serve our clients in many activities, as you can see, and our clients are importers, exporters, there are SMEs, large corporations, NGOs, pensions and payroll, or education sector, on incoming, outgoing, mass payment projects, and hedging solutions. Yes, we are really excited and proud of this new partnership with the Isabel Group, the reference in Belgium for multi-banking platforms, which allow us to offer the best international payment services, as well as the best insight on the economy and analysis of currency market. Today, one of our best senior market analysts, George Vessey, is here today to share his forecast and view on the US election, and we really hope that this presentation will help you to reduce the current uncertainties on the economy, and that will help you to move forward and decide in confidence. Enjoy the webinar. George, the floor is yours now.
Thank you, Marc-Élie and Vanessa, and a warm welcome to everyone this morning. As you know, we'll be focusing on the US election, which arguably couldn't come at a more turbulent time, really, against the backdrop of the ongoing pandemic, social unrest that we're seeing globally, and economic suppression. Of course, markets were already bracing for what was expected to be a tumultuous election for these reasons. But then we've also had the news of President Trump testing positive for coronavirus and also potentially cancelling stimulus talks before the election. And that added more uncertainty to the outlook. So, and it makes forecasting this outcome of the election and the market impacts that little bit more difficult. But we will discuss in detail some of the key dates on the calendar, as you can see here. The candidates, the polling trends and the electoral process, and of course the potential scenarios and the potential impacts on financial markets and mainly the US dollar. So if we move on to the next slide, please. To begin with, let's look at the key events, the key dates over the coming months. We've already had the first presidential debates and the vice presidential debate was in the early hours of this morning, both of which haven't really changed the dynamics of the race too much. They haven't offered too much in the way of new policy details. But the presidential debate last week showed that Trump's unwillingness to accept the result of the election if he does lose, and that was one of the key takeaways that we took from last week's debate. The next, the second debate between Trump and Biden is scheduled for October 15th, so next week, and the third and final debate for October the 22nd. And the election, it always falls on the first Tuesday after the first Monday in November. So that's why this year, this time round, it falls on November the 3rd. And it could take days or even weeks to find out who's actually won, particularly this year because of the expected surge in the postal ballots due to the pandemic. But as it stands, December the 12th appears to be the final deadline for each state to validate their results. And that would make December the 14th the final vote of the Electoral College to elect the new president. And then these votes will be recounted on January the 6th by Congress, and the winner sworn in on January the 20th, if all goes smoothly. If we move on to the next slide, please. So we'll have a look at the candidates then. Unlike many other countries, the US political system is dominated by just two parties, the Republicans and Democrats. The Republicans, the more conservative party, and their candidate this year is, of course, President Donald Trump. He's hoping to secure another 4 years in power. And in recent years, this party has stood for lower taxes, gun rights, tighter restrictions on immigration, and support for this party tends to come from the stronger support from the more rural parts of America. In the blue there, we have the Democrats, the more liberal party, and their candidate is Joe Biden. And this party is best defined for its more liberal stances on issues like civil rights and immigration and climate change. And it believes the government should play a bigger role in people's lives, like providing health insurance. And support for this party comes from more urban parts of the US. In the interest of time, I'm not going to go through all of everything you can see on this slide, but we know there's certainly a big divergence between sort of Trump and Biden's economic and fiscal policies, but there are some similarities too, such as tougher measures against China and the need for more infrastructure spending as well. In the second term, we believe Trump would focus on an America First approach to international trade and tax reductions, which might consist of making those permanent tax reductions of 2017 in place. And in contrast to that, Joe Biden is seeking to increase spending on climate change mitigation and expand access to state-funded healthcare, and of course raise taxes on corporations and high-income earners. So that's a brief overview of the profiles for the time being and the policies, but we'll discuss how they might impact market scenarios later on in the presentation. But if we go over to the next slide, please. We'll have a look at the polls and the potential outcome, as you can see here. At the top, you've got the line chart. It shows that Joe Biden is currently polling ahead of Donald Trump in the national polls. But although the voting intentions have been somewhat stable, he's seen his lead narrow in some of those key swing states since the summer. But nevertheless, he is still leading in some other key battleground states as well, like Arizona and North Carolina. In reality, though, these national polls do matter less than what is happening in the swing states, because if a candidate does win the popular vote, they could still actually lose the election because of the Electoral College, which I'll go into shortly. But first, states like Arizona, Georgia, that are traditionally Republican, they're far more competitive now in 2020 than they were back in 2016. And I'll also note that states like Pennsylvania, Wisconsin, where Trump won by razor-thin margins back in 2016, Biden is now leading just by a few points, but still it's bringing the race a lot closer. And other swing states like Florida and Texas, where we've seen COVID cases soar during the summer as well, again, that gap has narrowed a little, and it makes the race a lot closer this time round. So as I mentioned earlier, the American president is not chosen directly by the people, but by a group of officials known as the Electoral College. So how does that work? Basically, each state has a number of electors in the Electoral College proportionate to its population. So for example, California, the most populous state, has 55 electoral votes, whilst small states only have 3. And today, the Electoral College consists of 538 electors in total, and so a candidate needs 270 electoral votes to win the White House, as you can see at the chart at the bottom there. So basically, whichever candidate wins the highest number of votes in a state is awarded all of the state's Electoral College votes. And based on the latest polling data from across the states, Biden's advantage in the solid and the leaning states suggests he can secure that Electoral College majority without the swing states, perhaps. That said, those swing states do make up a large proportion of the Electoral College, as you can see in the grey there, and so it does make it an interesting race to the very end, really. And as per the 2016 result, it's a reminder that Trump can beat the odds. If we go on to the next slide, please. Another important aspect then of the US election is the composition of Congress, as this is going to influence how the next administration will function as part of the government that writes and passes laws. And voters will be able to choose on new members of Congress as well. Congress is made up of 2 chambers, the House of Representatives and the Senate. Members of the House serve 2-year terms, and senators serve 6-year terms, but senators are split up into 3 groups, meaning a third of them are up for election every 2 years. So with this in mind, as you can see from the pie charts, all 435 seats in the House are actually up for grabs in the election this year, while 35 seats out of the 100 in the Senate are up for grabs. Usually this would be 33, but 2 senators have stepped down, which is why it's 35. The important point to note here is that bar chart on the right there. Basically, out of the 35 seats, those 35 seats in the Senate that are up for grabs, there are twice as many Republican seats than Democrats. So this time around, 23 Republican seats will be renewed compared to just 12 of the Democrats. And so of course, that puts the Republicans at a greater disadvantage, if you like, or a higher risk of losing the seats and therefore potentially losing the Senate. Democrats, as you can see, have control of the House on the left pie chart there. They'll be looking to keep hold of that, of course, whilst gaining control of the Senate. And again, the important point here is that if they had a majority in both those chambers, even if Joe Biden didn't win the election, the Democrats would be able to block or delay President Trump's plans if he were to be re-elected. In a few minutes' time, we will go over some of the plausible electoral scenarios, 2 of which will result in a unified government, a blue wave or a red wave, and 2 with a divided government. So either a Trump or Biden victory with a Republican Senate and a Democrat House, for example. And for each scenario, we'll forecast a likely impact on the US economy, the markets, and of course, the US dollar. If we move on to the next slide, we'll have a look at how the dollar has performed in the immediate aftermath of elections in the past. So here, we've just rebased the dollar index here to 100 on the election date to provide that percentage change in the index in the 10 days after the election. So just to be clear, the dollar index is a leading benchmark for international value of the US dollar, as it measures a dollar's value relative to a basket of major currencies. And that chart on the left there highlights that historically the US dollar index usually appreciates after an election, whereby the new president, it's the first term of a new president rather than an old president being re-elected. Interestingly, it doesn't matter whether the president is a Democrat or a Republican. As you can see, after Clinton and Trump were newly elected presidents, we saw the dollar appreciate 3% in the 10 days after, and Bush and Obama saw the dollar rise around 2% in the 10 days after. And in fact, separately to the data that you are seeing on this slide, the Fed's trade weighted average or measure of the dollar showed that it strengthened in 100 days after the election, out of the past nine out of the past 10 elections from 1980 to 2016. So it's an interesting trend there that we're seeing. And it's worth noting that on those particular 100 days that the dollar performed better with a Democrat win, rising on average 4% versus 2% when Republicans prevailed. In comparison, we'll look at the chart on the right there. It looks at the market impact of an incumbent president winning. So if Donald Trump were to win again, potentially this is what you might see. So as you can see, if a president wins a second term, historically the dollar index has fallen in the immediate aftermath in the 10 days after. Now, of course, I'm not suggesting these trends are definitely going to play out. You know, in reality, what is interesting at the moment is that the dollar index is actually showing a positive correlation with the approval rating of Donald Trump, which would obviously contradict that historical trend on the right there. But as you can see, the dollar index did move barely anything like when Barack Obama sealed his second term. So perhaps this trend is less strong than the first trend on the left there. And moving on to the next slide, please. So this has been a hot topic of discussion. It's been high on the radar over recent weeks, the prospect of a disputed election result. If we're lucky, then this tense and dysfunctional election cycle will reach a conclusion in time to meet the crucial deadlines in December and January for the inauguration of the president, as we saw on the calendar slide earlier. This should be the case if the winning margin is wide and the victory obvious. But if the result is closer, then it's more likely that it will be contested. As I said, Donald Trump has already failed to confirm a peaceful transfer of power if he were to lose, and he expects the election battle to end up before the Supreme Court this time round. The big worry, though, is that it's not just that Trump might reject the result, but he tries to use his power to prevent a decisive outcome going against him. But in reality, based on the US Constitution, a president cannot state that an election is invalid. Of course, there's a possibility to contest the result, making an appeal to the Supreme Court, as I mentioned. But if the issue isn't resolved or solved by the inauguration date on January 20th, then the one that was elected should take office. And should be in the key word there. As we know, Donald Trump can be unpredictable. But if we look at this slide here, back in 2000, we did witness a contested election between George Bush and Al Gore. And it was 5 weeks after the result that the Supreme Court decided on Bush. And initially, the market reaction, we saw the US dollar strengthen because of its safe haven appeal. It's sought after in times of heightened uncertainty. But then the dollar and US stocks tumbled 2% and 8% respectively until the result was eventually confirmed towards late December. But beyond this date, both the stocks and the US dollar actually depreciated significantly. And bear in mind, this was Bush's second term, which does follow the trend we saw on the previous slide. But this time round, investors should be prepared for more volatility in the event of an inconclusive result, because markets abhor uncertainty. So it's reasonable to expect safe haven demand to pick up. We'll see investment into gold, US government securities, and potentially the US dollar again because of its safe haven appeal. But that might just be a short-term effect. And whilst that's going on, riskier assets and commodities could weaken because of that, along with pro-cyclical currencies. But the short-term, long-term impacts on the US dollar could vary. So a short-term depreciation, a short-term appreciation on safe haven demand, but then a depreciation as we saw back in the year 2000. If we move on to the next slide, please. So the market is certainly gearing up for a volatile election period and post-election period. And this chart here shows the 2-month implied volatility in euro dollar. And implied volatility, just to be clear, is the market's forecast of a likely movement in a securities price. So in this instance, euro dollar implied vols here measure the expected variation in the currency pair over the next 2 months. And we saw this gauge spike considerably higher during the height of the market turmoil back in March. And then once the election was captured in early September, we saw that premium jump once again, highlighted by that yellow circle, the first yellow circle on the right-hand side of the chart there. So basically, implied volatility can often be thought to be a proxy of market risk. It doesn't predict the direction in which the price change will proceed, but it just shows that large and unpredictable price swings should be anticipated. So with this in mind, market participants are bracing for a volatile election period, and the fact that the risk of a disputed election victory was growing means that expected volatility after the election result is also growing as well, based on the previous slide's analysis. So does this mean that the dollar itself was in for a short-term appreciation, as I mentioned, and then a depreciation in the weeks thereafter, as we're left in a limbo period, perhaps? However, we have seen over this week that longer dated implied vols on options are trading lower than the 1 month and 2 month. So the flattening of this implied volatility curve does suggest that traders are slightly more optimistic of a Biden uncontested victory, perhaps. It wasn't the case a few weeks ago, but it is now, and that's why we're seeing a flattening of that curve. Ultimately, a little bit of risk sentiment being removed from the market, but still the chance of a contested affair is still on the table and certainly threatens to rattle markets. If we can move on to the next slide, please. So as we know, it's going to be unpredictable. We should expect volatility, and certainly more volatility in a contested result. But what's the outlook for the markets and the US dollar in relation to different scenarios unfolding? So here we've got created a matrix with the potential scenarios that could transpire, their likelihood of transpiring, and what impact that scenario will have on the economy, trade, financial markets, and of course the US dollar. I'll say that the likelihood row there is based on current trends and surveys, and it's largely by the Financial Times and Real Clear Politics, and they are arbitrary, to be honest, which is why there's no percentage that's been allocated to each scenario. But it is the general tone across the main analysis out there, and it is based on multiple poll of polls, which, as we know from past experience, should be taken with a pinch of salt, but it is what the market's pricing at the moment. Anyway, if we look at scenario 1 there, so a blue wave, so a Democrats clean sweep, whereby Biden wins the election, Democrats hold the House and gain the Senate. Now, there's no shortage of debate over whether the Democrat or Republican policies would be better for markets, for investors. The negatives to markets would be, in this scenario, the rise in taxes and the tightening of financial market regulations. That would be a huge blow to corporate profits. But Biden, is potentially bad for technology stocks. It would also be good for green stocks due to his pledge of major investments in green energy industries. And also, on a positive side note as well, the Democratic sweep would boost spending on stimulus, healthcare, infrastructure, consumer spending as well is likely to pick up, and that would boost this risk cycle that we've seen. So a basket of winners and losers if you do see a blue sweep. In terms of the US dollar impact, it is a tricky subject based on the historical evidence that as we discussed in a slide previously. A new president is good for the US dollar, and a new Democrat president is usually even better. And the likely negative impact on US stocks could potentially be a positive one for the US dollar, given its inverse correlation with stocks at the moment. But this could just be a short-term impact, really. In the long term, these two tend to trend positively. In actual fact, you know, the general global risk-on result of a Biden victory, it could transpire into stocks actually climbing and the dollar weakening. You know, a Biden victory is associated with more fiscal stimulus, a multilateralism world where global trade picks up. That would likely benefit risk assets and thus weaken potentially the safe haven dollar in the short term and to medium term as well. The scenario 2 there is a Biden win, but a divided Congress. So it could be a neutral, positive initial reaction, but then a modest negative impact thereafter. So firstly, a split Congress accentuates this risk of a disputed election result. So that could cause a risk-off environment. And it would also potentially prolong that deadlock on a new stimulus plan. Again, be a risk negative and potentially boost demand for the safe haven dollar. But we could see, you know, also that tax increases are constrained as well by the Senate, and also potentially trade tensions and global uncertainty might decline. So you've got some positives and negatives there. Potentially you're going to see the dollar volatile off the back of that. And scenario 3, the red wave, Trump wins the election, sweeps up the House as well as holding the Senate, so full control. Therefore, we'll probably see an extension of tax cuts, potential infrastructure spending, continued deregulation, and that would probably boost equities. Risk rally could weaken the US dollar in that respect. However, with Trump with all the power, you could see additional tariffs on China and potentially other countries as well, and that could hinder global growth prospects and hinder risk appetite as well. So you could actually see the dollar depreciate in the longer term because of that. Scenario 4 then is just a status quo. So Trump wins, but the Congress is still divided. So we might see deregulation continue. Tax cuts are unlikely, but so are tax increases. But policy continuation is often cheered by stocks. So we might see that stocks continue to climb and the US dollar continue to fall in this instance. But what does come with this is more uncertainty, again, on trade and global conflicts due to Trump's protectionist policies. And because of this, we may actually see the US dollar gain on safe haven flows once more. So as I explained, it's a tricky one because of the dollar's safe haven appeal. And depending on the outcome, we could see differences in the dollar reaction on short-term and long-term basis. If we move on to the next slide, please. So the previous slide was quite detailed, I know. It's quite complex, as I mentioned, and very uncertain as to how the market and the dollar might react in accordance with a particular scenario unfolding. But let's look at the more longer term economic and monetary outlook here and how that might impact the dollar. So in a zero interest rate environment as we're in now during this global recovery period, volatility next year over the coming years could be driven more by fundamental aspects, with investors monitoring areas of solid and strong growth, but also keeping an eye on those general financial health of each of those countries as well. As we know, the US is experiencing its worst recession since World War II, like many other economies out there, but it might lag behind some of its peers in the recovery process, especially European ones, given the divergence in stimulus measures that we've seen. And the latest OECD projections of 2021 GDP show that the euro area is actually forecast to rebound over 5% next year, compared to the US at 4%. And that 4% is also forecast by the US Federal Reserve as well. And with this in mind, we could bring in the dollar smile theory here, which says that the US currency tends to increase in value against other currencies when the US economy is either performing extremely well or extremely poorly. So if the US economy is just a little bit above or below world growth rates, then the rest of the world does tend to overperform because of this kind of stability, and the dollar therefore underperforms. So even if we do see that growth pick up in the US, if we see it pick up a bit more elsewhere, then we could actually see the dollar weaken as opposed to strengthen. On the right-hand side there, we have the debt to GDP ratio and the Fed's balance sheet to GDP ratio as well. And the former compares a country's sovereign debt to its total economic output for the year, which in the second quarter of 2020 reached a record 135.6% in the US. And that is a currency negative scenario. Basically, a high ratio means a country isn't producing enough to pay off its debt, which raises concerns about default. But the Fed in this instance can simply print more dollars to pay off that debt, which is what we're seeing through the expansion of the balance sheet as well. So the risk of default is of course extremely low, but governments are striving to lower that debt to GDP ratio, as it can be difficult to, achieve this during times like we're experiencing in the global pandemic because of the economic recessions that we're in. And in such climates like this, governments tend to increase borrowing in an effort to kind of stimulate that growth and boost aggregate demand. And in a Biden victory, we'd likely see an increase in the debt to GDP ratio in the short term because of this. But over the longer term, if these stimulus spending plans are successful, then hopefully that recession will lift, taxes and federal revenue will rise, and the debt to GDP ratio should level off. So this should weaken the dollar in the short term, as I say, but possibly boost it in the long term if it has its desired effects. Though another point, though, is that if central banks succeed in lifting inflation in a low interest rate climate as we're in, then we'd get a capital rotation into risk again, which is obviously potentially US dollar negative as well. It does depend on dollar liquidity too, though. So if the Fed prints more money, so a liquidity expansion, then the dollar's value would fall. But when the Treasury starts to issue more debt to raise cash to support the government's activities, market participants will then buy that debt with US dollars, which is essentially taking away that liquidity from the market. There may be a shortage of cash there. We could see a higher price for the US dollar, so the US dollar strengthening in this instance, similar to that market reaction that we saw in March with that dollar funding issue. And the next slide, please. So finally, let's look at the 2021 currency-specific scenarios. They've been constructed with the help of our partners at Oxford Economics, a leading global economic forecaster. They aren't predictions per se, but they offer some guidance on different FX scenarios to help businesses plan for the future. And I think we can all agree that there are always a range of factors driving currency markets: global trade, economic data, confidence, monetary policy, politics, seasonal trends, and even technical indicators as well. There's ample factors, and we've discussed specifically today the US election race and how markets might react, particularly the US dollar. But in reality, we have to bear in mind there are a plethora of factors that need to be considered that can cause that capital rotation. But the crucial point of this slide is to just gauge how or why the exchange rate could rally or crash as depicted by these scenarios. And I think one of the key considerations of currency trends looking forward will largely depend on how well nations are going to cope with second or multiple waves of the coronavirus in the absence of a vaccine, and how that's going to impact consumer and business confidence, behavior, and activity, and how that's going to have a knock-on effect to monetary and fiscal policy going forward. And the high scenario there, scenario one, as you can see, is mostly associated with a more successful management of the virus in Europe, with localized or minimized lockdowns as well, compared to the US, where we might continue to see a mismanagement of the US economic recovery as well. And this may be a result of a Trump election, perhaps election victory, if we see those extra stimulus measures not put in place quick enough. Looking at a longer term chart, we've already seen actually that this currency pair has broken away from a 12-year downtrend. And perhaps this is the start of a new long-term uptrend for this currency pair, particularly if the US economy does suffer harder and interest rates remain lower for longer in the US. Is this going to trigger more demand for the euro and fuel a run up to those 130s in the latter half of the year, as you can see on the chart there? The risk to the downside, though, or rather that low scenario you can see there, is arguably going to be triggered through renewed safe haven demand as a result of another intense wave of infections globally and lockdowns globally, and a potential financial crisis as well, which interestingly, our partners at Oxford Economics produced a survey recently that revealed global businesses are actually more concerned about a potential financial crisis more than a second wave of infections and lockdowns now. So we can't rule out such a move to the downside there, especially if we see a repeat of the dollar funding squeeze, as I mentioned earlier, which dragged euro dollar to a 3-year low in March this year. A final disclaimer though is, the situation does remain fluid across the globe, as particularly with the coronavirus, but even with the US elections. And these forecasts here, they're not predictions I'm not predicting that one of these scenarios is going to happen, but rather it's revealing what the downside and the upside risks are, and how or why they might play out. And then from here, it's important to make sure that your business is prepared for any of these eventualities with a strategy, and then you stress test that strategy. Is it flexible enough to take advantage of favorable currency moves, and is it robust enough to weather the worst storm? But that's it from me. I'll hand you back over to Vanessa.
Yeah, you can, of course, follow us on LinkedIn, Twitter, or YouTube and get the latest market news. You will receive the link of the webinar, of course. And this webinar has been recorded as well. Vanessa, if you can move to the next one.
Yes.
Yeah, our international payment services now and capabilities are now live and available on your preferred Isabel 6 platform on the payment screen. And then, as you can see, you can choose the button Find the Best Rates and click on the button Add Services to simply benefit from our services.
Thank you so much to both George and Markeli. I think George had a time to take a deep breath after his inspiring insights. And I would suggest that we tackle some questions now. I've seen a couple of interesting ones. George, it's for you. First question, a very nice one. Do you think the election can be postponed or cancelled? And what would be the impact on the dollar?
Thanks, Vanessa. Basically, it's never actually happened before, even during wartime. So I don't think, or we don't think that this is going to happen this time round. Based on the US Constitution, only Congress, not the president, has the power to postpone or cancel an election. But given that Congress is split, it is a very unlikely scenario. But in any case, as per the Constitution, the 20th Amendment, it's clear that the terms of the president and the vice president do come to an end after 4 years, and that falls on January the 20th at noon. So the inauguration of the new president does have to take place on that date. So even if it was postponed for whatever reason, it doesn't really allow much time before that new date. If it was postponed, then of course we would likely see a lot of uncertainty in the markets. Markets don't like uncertainty, so we'd probably see safe haven demand for the US dollar initially. But if it was cancelled altogether, then the volatility across the board would be rife, I imagine. And again, short-term impact would likely be dollar appreciates. But then we're left without a president for some time, and that could certainly cause some ruptures across not just the US but the globe, and the impact on the dollar could subsequently be negative.
Okay, thank you for that. We have a second question that came in, also a very interesting one because there have been rumors around it. Has Donald Trump the power to contest the result of the election?
Yeah, So as I mentioned in the presentation, legally you can do that. Al Gore did that in 2000, as we saw in the presentation there, contested the votes, the count that we saw of Florida, and George Bush was eventually announced the winner of that election. It will certainly be Donald Trump's strategy, I imagine, to contest the result, especially if the election is tight. In certain swing states, but as I mentioned before, the appointment of the president is based on the vote of the Electoral College, so you don't need to win the popular vote to win the election, as it was the case in 2016 when Donald Trump won without winning that popular vote there. So he certainly has the power to contest, and I imagine he will if it's a tight race. And the impact on the US dollar, as we saw from the presentation, would likely be a short-term appreciation because of safe haven demand. But if it's anything like the year 2000, then we could see the dollar in for a long decline along with US stocks as well. So there could be potential for maybe 3 to 5% decline over the rest of the year if that was the case that the election was contested.
Okay. Thank you for that one as well. I'm just being time conscious here, so I'll take a last one, and that's pretty straightforward, I must say. First of all, you get a congratulation for one of the participants for the excellent presentation, and then a simple question. Well, how can I contact the FX risk management experts from Western Union?
I can take this one, George. Simply through your Isabel 6 access by using the button Find the Best Trades, and again you can here access to our services. Otherwise, don't hesitate to follow us on LinkedIn. You can as well send us an email on the website. We will be happy to contact you immediately in order to start our relationships, of course.
Okay, great. Well, before leaving you, I just want to highlight that we definitely hope you found this presentation insightful and that you have learned how you can potentially adapt your US dollar hedging strategy accordingly. Let me thank you once again for joining us today, and just be informed that we will also send you a link with the video. So the webinar was recorded, so you will definitely get that as well. We will now end this webinar, but we also give you the opportunity to take a survey. Needless to say that we very much value your opinion, and your feedback will help us to improve as needed. Moreover, should you still have questions that remained unanswered, please also use a survey to highlight that and ask to be contacted to discuss your concerns or considerations around the US dollar or even other currencies. Again, thank you very much, and let's talk soon.